Hello, everyone. I'm Scott Sowell from AMVEST Capital. We're thrilled that you could join us for today's webinar, Why Are We Losing the Critical Minerals War? Geology, Metallurgy, Trading, and Investment in a New Era of Resource Nationalism. Brought to you by our team here at AMVEST TERRADEN. A special thanks to our partners at Coherra for making this webinar possible. Before we dive in, a quick disclaimer. This webinar is for informational purposes only and does not constitute an offer to sell or solicitation of an offer to sell or buy any security. It should not be relied upon as a basis for investment decisions. Now, let me begin by introducing you to AMVEST TERRADEN, the driving force behind today's webinar. Our focus is on companies that explore, develop, and extract critical minerals. These minerals are not just resources, they are the building blocks of technologies that are shaping our future. From defense to transportation, energy generation, and storage, these technologies span various sectors. What sets TERRADEN apart is our unwavering commitment to ESG compliance. We exclusively support companies operating within the Western value chain and ensuring that these are not tied to Chinese or Russian interests. This approach aligns with our dedication to sustainability and responsible resourcing. Today's conversation could not be more timely or more urgent. From cobalt in the Congo to rare earths in Greenland and titanium in the Ukraine, critical minerals have become central to a new kind of global power struggle. These resources underpin the energy transition, national defense, and advanced manufacturing, and they increasingly determine geopolitical leverage. And while rivals move decisively to secure control of both resources and refining capacity, Western markets remain fragmented, slow-moving, and underinvested in strategic execution. We're seeing this dynamic play out in real time. As we are all very aware, last week the White House announced sweeping new tariffs, raising import duties on nearly all U.S. trading partners. Just moments ago, Trump posted he would be halting implementation of reciprocal tariffs for the next 90 days for everyone except China. This move further escalates tension and places a strain on already fragile supply chains. These developments aren't isolated. They reflect a broader trend of resource nationalism and economic decoupling that is reshaping global trade, especially in critical minerals. What's at stake isn't just trade balances, it's strategic autonomy, industrial resilience, and who controls the future of everything from clean energy to defense technologies. So today we're asking the hard questions. Why has China been so successful, and is it too late for the West to catch up? What is refining the West's most dangerous bottleneck? What's holding back private capital? And most importantly, where should smart capital be looking at this landscape continues to evolve? To help us answer these questions, I'm joined by two exceptional colleagues from here at AMVEST TERRADEN, Stuart Macliver and Tomasz Nadrowski, who bring direct experience in strategic mining investments and project management. Their extensive knowledge and combined experience in natural resource investments make them the perfect guides for today's discussion. Stuart is not only co-founder of AMVEST TERRADEN, but also managing partner of AMVEST Capital, a New York-based specialist investment management and corporate finance firm dedicated solely to the natural resources sector. Based here in New York, Stuart combines his finance and geology expertise to evaluate natural resource opportunities from both technical and financial perspectives. With extensive experience in corporate advisory and transactions, Stuart has worked across M&A, equity, and debt capital markets in the natural resources sector. He holds a Bachelor of Commerce from the University of Western Australia, is a member of the Institute of Chartered Accountants in Australia, and has a graduate diploma in geology from the Western Australian School of Mines. His unique blend of financial acumen and geological knowledge make him a valuable resource in understanding the economic and environmental implications of critical materials. Tomasz Nadrowski is our portfolio manager. He is a seasoned expert in mining investments with over 25 years of global experience. His career includes roles as portfolio manager, commodity strategist, and commodity analyst at various firms across North America, the UK, the Netherlands, and Johannesburg. Tomasz is a former director of the World Economic Forum, holds a CFA charter, and is fluent in an impressive 7 languages. He earned advanced degrees from the School of Economics and Social Sciences and the University of Geneva. Following the formal presentation today, we'll open the floor to questions. And we especially value questions from the audience, so please submit yours in the chat or questions tab, and we'll try to ask them of Tomasz and Stuart in real time. And with that, I'll turn it over to our speakers.
Great. Thank you, Scott, and thank you, everyone, for joining us today. Those who were with us about 3 months ago may remember that we focused on one of the weapons that China would have in an incoming trade war. And that came to be last Friday when China retaliated against Trump's first reciprocal tariffs and the previous tariffs against China. So about 54% at that time. It's growing real fast. But anyway, the retaliation consisted, among other things, in restrictions for exports of critical minerals, in particular rare earths, actually only rare earths, 7 different elements. So today we'd like to ask ourselves the question, why China is so powerful? Is it because of geology? Is this something about their metallurgical industry, something about trading? And then why the Western response has been so weak, and Stuart will contribute a bit later with some findings to this effect. Just before we go any further, let us delineate a little bit the topic. Just let's define what we mean by critical minerals. We usually here at AMVEST TERRADEN subcategorize this into 3 different segments as per different types of China policy. So first segment is specialty minerals, relatively small markets, very specialized, so which includes such elements as antimony, tungsten, bismuth, fluorspar, gallium, germanium, several others. In China usually tends to restrict exports of those materials. The second group are battery materials. These are volumetrically much larger markets. These are, of course, cobalt, nickel, lithium, graphite, manganese, also vanadium. And here the strategy is to flood the market, keep the prices as low as possible, disincentivize investment in the West. And then the third group is rare earths, sort of a category on its own, where Chinese policies are much more sophisticated, much more wide-ranging, recently even affecting inflows of the material into China from Western juniors. And that's probably kind of a complex topic to which we can devote a separate webinar one day. So the geology of China, just let's start there to find out if there's something absolutely unique about it. Well, the knowledge of this geology really improved in the 20th century, first thanks to German and British capital, and then thanks to Soviet scientists. What you find here, a couple of colors for those who are not really well-versed in geology. Don't be afraid. It's very simple. So what you see here is essentially 4 colors. Orogenic material. Orogenic means mountain building. That's here kind of green and bluish. Then there are a lot of shields, so very ancient Precambrian rocks, mostly igneous and high-grade metamorphic material, orange here. Then the pink are platforms, sediments, some of them metamorphosed sediments a little deeper. And the most interesting for us would be this yellow one, the passive margins on the margin between oceanic and continental lithosphere. And here's why this is interesting. Because if you zoom in into Chinese geological regions, you find out that that element in the south, in the southeast, the so-called South China Craton, is actually much younger than other rocks. Why is it younger? Well, actually, it was part of Gondwana, the southern supercontinent historically, from which we have Africa, South America, Australia, New Zealand, India, bits of Balkans, and also this part of China. As you may know, Gondwana is very rich in cratons, and cratons are rich in metal ores. So if you think mining, often you think South America, Australia, or Africa, or, by the way, this part of China. It's often forgotten. So it's a sort of a separate geological region in the country. For those who are not familiar with China's geography, let me just run a quick parallel here. So in the north, you have, of course, the political center of the country. In the middle, you'll find the main avenue historically for trade, the Yangtze River and its canals that were built by slave labor during imperial times. And in the south, that area of interest for us, the southern Craton. And if you flip it by 45 degrees, so let's do it for the sake of illustration, what you find in the east now is the center, political center. What you find in the middle is the north-south artery, and in the west, areas that are of geological interest. What does it remind you of? The United States. right, with Mississippi, Missouri in the middle, and what we call federal lands here. There is the lands that was acquired by U.S. from various powers in 19th century with very interesting geology. Most of the mining in the U.S. takes place in the West. So in a way, a similar context, just different axes. So if we zoom in a little bit, you'll find out that at the beginning of industrialization, Chinese geology didn't little in the way of high quality iron ore. There is hardly any bauxite. There is copper, but not sufficient for that level of development. However, with the complexification of technologies, today we need a lot more different minerals that we needed even 30 years ago. Even if you think about your sound system, or your car, or your screens, today they have between 2, 3, or 5 times more minerals that back then. 100 years ago, when Kaiser Wilhelm was launching the First World War, he needed about 7, 8 different minerals. Well, in your pocket, the smartphone has about 25 to 30, depending. So for that, the southern part here, you see with a lot of hydrothermal, a lot of porphyries, a lot of other igneous deposits. There's a wealth which brings the variety of mineral endowment that's really remarkable. And that kind of fits this complexification of technologies today. So let's just go bit by bits. Mining really started in China in 14th century before Christ, a long time ago. It was copper in Jiangxi province also well known for its porcelain. And it's here that we also find ionic clays with rare earth today. It's here that we find lithium with tantalum in lepidolite, mostly deposits, so low quality with mica. But this is not the only area where you find lithium in the country. There's also lithium, very different deposits in Tibet. That's brines mostly, sometimes with boron, and unfortunately also with magnesium, which makes it kind of a complex processing. Qinghai, a little further north. These are geothermal lithium deposits. And if we stay a little bit here in the north, usually there are no platinum group metals in China, with the exception of these areas, a bit of chromite and PGM of very poor quality. Also in the north, so in those older rocks, we find nickel in Gansu. This is where Soviets helped Chinese build their first nickel smelter in Jinchuan. The company exists till today. It's an important part of the stainless steel business in China. Also in the north, we have manganese in inner Mongolia, southern Mongolia. That's in sedimentary deposits, but that's not the only source of manganese in the country. We find also manganese in the south, in places such as Hunan, famous for spicy cuisine, Guangxi, Guizhou. However, the quality of these deposits is not sufficiently high. Therefore, China imports quite a lot of manganese from South Africa and from Gabon. Niobium is in a similar situation. So niobium, you can find it technically in Shandong Peninsula, famous for its noodles. However, the quality is such that most of niobium is, of course, imported from Brazil, although some can be found also in the south and in Fujian. And let's stay for a little longer in the north, because in sedimentary deposits, metamorphosed sedimentary deposits, we find flaky graphite. It's a very important element of the battery value chain. That graphite is found in Heilongjiang, the river of Black Dragon in the north, former Manchuria, and also in Shandong. However, it's not processed there. It's processed in the south, and that's an element that I will sort of dwell on a little bit when we talk about metallurgy, why that happens, right? But really things get interesting when we move south, consistently south. So in Yunnan, we have the world's only primary germanium mine. So it's one of those specialty metals. The mine called Linzang in southern Yunnan province was found in 1950s while exploring for uranium. This is actually germanium-bearing coal seams. Strangely, there's, I think, only one other deposit like this in the world in Bulgaria, and it's not exploited at the moment. Then antimony. So antimony is one of those elements where China is very richly endowed, starting with Hunan, where the largest deposit in the world is located, Lengshuijiang, and also a little further north in Hubei, famous for example, its Wuhan virus, as well as in Guangdong, the That's a place where I remember mostly for its yummy snake salads. Tungsten, another element, very well represented in a variety of different settings, from porphyries to tungsten skarns. You'll find it in Yunnan and across in Myanmar. You'll find it in the northern part of the Yangtze block of South China, Creighton, and you find it also with the hydrothermal fluids that, from the igneous environments were interacting with carbonate-rich rocks. Therefore, the beautiful, beautiful skarns of Guizhou and Guangxi in the south. And then finally, last but not least, it doesn't matter whether the cat is black or white, as long as it's made of rare earths, as the famous communist poet should have said, but he didn't. And two types of rare earth deposits in China. In Inner Mongolia, it's a carbonatite-hosted, very rich, essentially iron ore deposit with various bells and whistles, and something quite similar in Sichuan. In the south, these are mostly ionic adsorption clay deposits in a variety of settings, from Jiangxi, Guangdong, Fujian, Zhejiang, Yunnan, Henan, and Guangxi. So it's very, very rich. However, not all of these critical minerals are found in China in sufficient quantity and quality. So domestic deposits are, for example, insufficient for the needs in lithium, in manganese, cobalt, that you didn't hear me mention here, niobium, tantalum, boron, and nickel. And among others, of course, iron ore, which we don't count as critical minerals, but China does, because it's not very well endowed with high-quality iron ore, mined mostly in Liaoning, in this seafood place in the north. All right, so let's move to metallurgy, because much of this subsoil wealth would be of little use were it not for the excellence in metallurgy and inorganic chemistry, which is undeniable. So those who are investors in nickel still probably remember in the first decade of this century, when Chinese producers stormed into the nickel markets with a profitable formula to beneficiate nickel pig iron. And really, metallurgy, so midstream, has been an obsession for the regime. It's kind of typical for dictatorships, from Wilhelmine Germany through the Nazis and Stalin all the way to the PRC, because, well, a lot of metals, big assembly lines, it's going to churn out a lot of equipment for the army, which is there to protect the regime. So Mao Zedong, when he channeled his inner Stalin, he quickly wanted to build a metallurgical system similar to the one existing in Soviet Union. Then after the split, they continued with some catastrophic results. This is illustrated here in this slide. So great leap forward, and the infamous backyard steel furnaces, where villagers were forced to make China the greatest steel producer at that time, which translated into massive famine. Metal first, food maybe second. But even in post-Mao China, the state retained a very high level of control over the metal business in general, both mining and metals and metallurgy. So starting in 1994, with the depreciation of renminbi, it's been always the Chinese government and not the market that determined the cost of capital. Important, keep it in mind when Stuart speaks about the Western market. So, for example, for an economy that grows at 10%, lending money by state-owned banks to state-owned enterprises at 2% is basically an expressway to overcapacity. Two things, however, should be kept in mind, is that over this period of time, parts of Chinese economy went through different reforms. And these reforms, I characterize them as gradualism, where it matters for this market, both horizontal and vertical gradualism. Well, what is a horizontal gradualism? You might remember at the beginning there was special economic zones, so locations where Western capital and technology were channeled into, and that turned into very powerful industrial parks. And that really matters for metallurgy. And I'll give you an example here, which we obtained from our friends at BlackRock, an Australian company with a graphite project in Tanzania. It illustrates what needs to happen in a graphite business necessary for anode production. So in the middle, you have a plant that spheronizes graphite. Graphite is mined in a flaky form, and it needs to be spheronized into spherical form. That's fairly difficult, and it's difficult to make it profitable unless that plant is somewhere close to a chemical plant here at the bottom left and steel plant here in the bottom right. Well, there are 3,000 steel mills in China compared to about 100 in the US, of which only 8 are fully integrated from iron ore to steel. So maybe it's not that difficult to collocate that plant next to a steel plant in China, but you still need a chemical plant. What for? Because that spheronization requires hydrofluoric acid, which is 3 times more powerful than the nuclear reactor. So you need a chemical plant. What for? Because that spheronization requires hydrofluoric acid, which is 3 times more powerful than the nuclear reactor. So you need a chemical plant. What for? Because that spheronization requires hydrofluoric acid, which is very dangerous, toxic, difficult to permit transportation. So that plant has to be somewhere close. So first you have that problem. And then you have a problem of waste streams. So waste streams, there's 60% of what you produce as fernization plant ideally should be beneficiated somewhere. Steel making is one option. There are some other, there's other research currently, but it's very difficult to make fernization plant viable on its own without being integrated into a larger industrial center with those locational synergies. So that's the horizontal gradualism. So slow opening of the market that has this very positive externality of concentrating everything in one spot. The second one is vertical liberalization. So as in 1990s, the government realized that state-owned enterprises will not be able to compete against, say, Western or Japanese brands in, I don't know, toothpaste or yogurt. However, the government retained most of the upstream industries, basic chemicals, metals, utilities, energy, and of course, banking. So private entrepreneurs were free to create their own brands such as iPhone, Walmart, Pizza Hut, and the unforgettable Obama fried chicken, right? But everything that's upstream remained in the hands of the Communist Party. So that's the vertical liberalization, always partial. Now, how come the West missed out on this? Well, partly because dogmatically, Western liberals believe that as an economy develops, its intensity of material use and energy use, by the way, will slowly ebb away, slowly decline post-urbanization, industrialization. Well, that never happened in China. In fact, it continued to increase, especially in poorer parts of the country. So this theory just simply was not corroborated in Chinese case. The voracious metal business kind of fed on itself, with scale begetting more scale. And there's nothing really deterministic about it or about the size of a country. It's really down to decisions, how the government decided to promote production over consumption. Of this production, metal production was an important part. So today, you can say that India has a GDP in terms of purchasing power parity where China was about 12 years ago, and we really do not expect a similar level of massive public and private investment with fixed investment into metallurgy at that scale. So it's really not about the size of the economy or demographics. It's about the decisions. Now, what are these decisions? The decisions are mostly about pricing of factors. So let's say underpriced land. So refineries, metal refineries have land allocated on a concessional rates basis, much cheaper than sand for residential purposes. The tax treatment is different. There are energy subsidies, and there are those special zones benefit also from very lavish public spending on infrastructure for production, not for consumption. So that's land. Then, of course, we have labor. There's a surplus labor, or there's been a surplus labor always in the countryside. There's a very restrictive labor law with this kind of apartheid-style hukou. If you're a villager, you don't benefit from economic and social rights by moving to the city, so you never become really a citizen. That was a system that was inherited from Bolshevik Russian propiska system. And so the price of labor is under control. And then the most important, of course, capital, because we're talking about capex intensive industry, right? So today, capital requirements for a new copper smelter in China are about 50% of what you would pay anywhere else in the world. And that cost of capital for these purposes was significantly below the growth rates and significantly below the inflation rates. So not only was it cheap, but also non-cyclical. And we are in a commodity business, so cycles usually are important. So the cycle risk is taken away by the infusion of capital, which was non-cyclical, even counter-cyclical, by the state-owned banks. Now, how did the West lose its metallurgy? Because so far I'm talking just about the pull factors. What about the push factors? And of course, a lot of push factors, starting with the design. So let's imagine you have a startup in California, and it thinks of investing in some new widgets, right, in inorganic chemistry or metallurgy or something. Well, that's going to involve long development cycle, high upfront capex, significant cyclical risk, and very complex supply management. So that's kind of venture capital backer. If he has a choice between that and software, or maybe biotech in the lab, it's going to go for the latter. And so little by little, high-end hardware manufacturing started to migrate to Taiwan, South Korea, Japan, and lower grade, higher volume manufacturing, of course, decamped to China. Lower margin, high volume, because if you see this kind of inversed organ diagram here in metals in general, or in mining in general, because that includes, by the way, diamonds, the margin, however cyclical it is found on the mining side and the end product, and not so much in the middle. So if you're in refining, you're working in a low margin environment, you better have high volumes. And finally, there's also a question of invention or inventiveness. So a lot of the products which are mineral heavy, such as batteries, NMC batteries, LFP batteries, were invented not in China, but in the United States. However, a couple of things happened in the 90s and then early 2000s. First, of course, open source research. And then in 2006, US Supreme Court terminated the Federal Circuit's practice of easily granting injunctions in cases of alleged patent infringement. And that sort of relaxed the intellectual property conditions that, among other things, promoted or prompted the biotech revolution since the late 80s. Now, not all of this is about stealing, or, research scientists and so on, because very often there's this unwritten rule that lasting technological disruption often emanates not from the most promising bleeding edge inventions. They're actually often very well protected, but from technologies that lag slightly behind, so second best or third best, because the entry barriers are much lower and the incumbents don't care so much. That's what happened with LFP batteries, for example. So lithium iron phosphate batteries that were considered in the West sort of secondary interest. There's range anxiety because they have low density, energy density, but incremental improvements, of course, help. And if you can test the market at scale, so for actual production volume, then, and rather than just some disembodied ideas, then slowly you will advance and innovate and improve with operational learning. The result of this all is that we have today a self-contained, powerful metallurgical center of the world, which is in China, in a country that represents 17% of global GDP, but 32% of global manufacturing. And fixed asset investment in non-ferrous metals business has been growing for over 3% a year, while it has been shrinking in the West and continues to shrink, because I think 10 days ago, we heard that Glencore and Trafigura are planning to close their smelters, zinc and copper smelters in the West. And that you'll find that while the demand is actually high in China, often represents a big chunk of demand, half or even higher, the processing capacity is even higher. And that's let's use example of antimony, right? So China represents 60% of global antimony demand, but the PRC also controls 80% of the production, or something that's not even here on this table, which is high purity non-ferrous metal industry. So things such as cadmium, tellurium, selenium, and indium. China has 46% of demand, and the bulk, about 80% of processing. The West realized this during the big wave in gigafactory investment in around 2020, 2021, where about $300 billion were committed to gigafactories. And what are these gigafactories are going to be fed with? Minerals from what? Well, value chains are disaggregated, except, of course, with COVID, we realized that wasn't necessarily a very good idea. And then there was a problem of financing for mostly startups, both in mining and in battery making. Stuart will illustrate it in a moment, how catastrophic the result of this was. And we know it also from metallurgy, and we know it from European catastrophes such as Nordvolt and so on. But all of this would be still insufficient or incomplete if we didn't pay attention to trading, because, of course, commodities are generally traded. And communist regime kind of leans towards autarky, but it doesn't have everything geologically. So how does it solve that? Because the party will be always reluctant to relinquish control over the flow. And yet, by 1990s, when China appears, there are already functioning commodity markets. And these commodity markets are two types. One is more kind of financialized, such as copper, zinc, or aluminum. And the other one is negotiated prices on an annual basis. Iron ore is a great example. There are also some other, uranium or potash and so on. So autarky is not a solution. The Soviet pattern is not a solution either, because Soviets tried to completely extirpate price signals along the value chain. And then when Gorbachev came trying to reinsert it, the whole system collapsed. Of course, the Chinese Communist Party didn't want to copy that model. So what did they do to move change the rules of the game? Well, to understand it, we have to actually move back in history, understand the difference between the concept of the market in the West and the concept of the market in China, which is actually an interesting thing to do in metals. Why? Because long distance trade is actually a child of metallurgy. When we humans moved from Stone Age to Bronze Age, well, what is bronze? Bronze is an alloy of tin and copper. The tragedy is that tin and copper don't co-occur in the same place. We mine copper from sulfide, tin from oxide, and for example, in Roman Empire, tin was sourced usually from Devon in Britannia, whereas copper in Cyprus or Dacia in Romania or Iberia, for example, right? And China wasn't very different. Tin came from Yunnan in the south, and copper from Yangtze River Basin. However, what was different between Europe and China is that in China, Han Dynasty monopolized mining industry. So mining industry back then, mostly iron ore or salt, basically to finance military campaigns. That's not the case in Europe. Here, Europe on the map. In Europe, monarchs technically owned mining. However, they granted mining privileges to individuals, cities, estates, and so on, and only perceived a chunk of this called berkregal or royauté, which is royalty. And we have royalty to this day, of course, in mining investment because of that tradition. But that also means that with a large number of owners, the markets develop with this sort of network that's crisscrossing Europe and developing the junctures, north, south, east, west, developing contracts, developing financial instruments such as bills of change. None of that happened in China, where there was only one axis, east-west axis, extending this Yangtze River axis into the Silk Road. Silk Road was also a Han Dynasty project of conquest and expansion into the West, including Xinjiang, what we call Xinjiang today. So that's how historically it developed, and the West, of course, was more advanced in terms of financial instruments. The first stock exchange in Amsterdam, and then, of course, we have Japan and the futures in 17th century, and Chicago Board of Trade for commodities 19th century, 1877 London Metal Exchange that fed industrial revolution. The Qing dynasty didn't have anything comparable in 19th century. So fast forward now to the modern days. And we have, of course, on the one hand, markets that function for basically efficiency. So price is discovered by markets as determined by the laws of supply, demand, and access. And I think these days, in the last couple of days, we pay more attention to that access connectivity between supply and demand. But that's not how the Communist Party perceives the role of the markets. They wouldn't allow exogenous market sanction to determine prices. And therefore, the strategic goal is to ensure plentiful supply at a low price for the domestic manufacturing for which there is no sufficient local demand. And that's important. Let me just repeat it. It's not about market efficiency. It's about ensuring plentiful supply at a lowest possible price for domestic manufacturing for which there is insufficient local demand. That's what it is. So how different is it from the West? Well, it's very different because when an Australian or Canadian junior goes to Africa, South America, to explore for a critical mineral and hopefully develop this and maybe build a mine with the help of a major, it takes all the risk, the price risk, the cycle risk, the market risk. The off-taker is not there. And of course, there's jurisdictional risk as well. None of this applies in the case of a Chinese miner because the Chinese miner is not alone. Chinese miner is part of the SPV of a consortium in which offtake is already guaranteed. He or she wouldn't go to the Congo for cobalt without offtake being already guaranteed. So you take away that risk. You take away the cycle risk, as I mentioned, because of counter-cyclical financing. So there is no market risk essentially because you have pre-sold something that you didn't really produce yet. Price risk is off because it's a long-term arrangement at the lowest possible risk. However, you're subsidized as well. And so there's still jurisdictional risk. Well, maybe, but your government and local host government are also negotiating adjacent projects such as infrastructure that usually supports both energy and metal mining ventures in a different way because energy is usually done through service deals, whereas mining through direct equity acquisition. And if the government doesn't like the price, it's going to intervene, as National Development Reform Commission has done in copper. Several times we had issues with iron ore, and in 2023, the government really disliked rare earth prices, summoned all the players, and asked them to reduce the prices, which happened. So don't expect China to create a Trafigura or Gunvor or Vitol or Glencore, because that's not going to be the role of Chinese traders. Chinese traders' role is to keep the price stable and as low as possible. The best example, China Oil and Foodstuffs Corporation, COFCO, which deals with foodstuffs and oil, so things that translate into consumer price inflation sooner than metals. And its role is to diffuse any signs of consumer inflation, because as you know, if prices of grain are high, you have high inflation and risk of the revolution. Think about Tiananmen 1989, or for example, Algeria during the Arab Spring. Algeria imported a lot of grain, so a lot of grain, no inflation, no revolution. Everywhere else, not enough grain, inflation and revolution. In the metals, of course, it takes longer for prices to translate into consumer price inflation. So let's say it's less important. But even here, the government has been trying to consolidate over a long period of time. And depending on the role, whether China is a rather producer, rather consumer, so wherever is a consumer, it's going to be a monopsonic or oligopsonic dominance. China Minerals Resource Group is a good example in iron ore business, where it kind of consolidates all the buyers in China as a interface to the three or four largest iron ore producers around the world. And it's a little different in non-ferrous metals, but even there we have attempts at consolidation because of the overbuilding of smelters, like in copper, and increased state-owned ownership of those copper smelters. Some companies, such as China Molybdenum, so CMOC, actually purchase traders. They bought IXM from Louis Dreyfus, a commodity trader and international group, mostly to purchase peripheral copper feed from, say, artisanal miners in South America or elsewhere. So that's what the government's seeking. Government's seeking a highly concentrated, if possible, oligopolistic or oligopsonic market structure, with government agencies retaining direct supervision over funding. All right, so I'll leave it now to Stuart to tell us more about how things look or have looked in recent years on the western side of the divide.
Yeah, thanks for that overview, Tomasz. So I'm going to dive into the history of how the mining sector has been financed, three big mining markets, and some examples of how Western mining companies are financed versus the Chinese companies. In ancient and medieval times, mining was largely funded by monarchs, empires, wealthy landowners, or forced labor, like in the Roman or Incan empires. In the ancient and classical eras, gold, silver, and copper were mined commercially in ancient Egypt, Greece, and Rome. The Romans had large-scale operations, especially in Spain and Britain, with sophisticated engineering like aqueducts to mine gold. These operations supplied coinage, weaponry, and other prestige items. Fast forward to the medieval period, silver mining in Central Europe, like the mines in Saxony or Bohemia, became commercial, supplying mints and drove early banking systems. The Fugger family was a large mining, merchant, and banking family in this era. Tin and lead mining in Cornwall in the UK was already commercially significant by the 13th century. Demand for coal surged during the Industrial Revolution, and it was the first time that mining became massively industrialized, financed through capital markets, and central to the entire economy. It marked the transition of mining from selective high-value extraction, such as in gold and silver, to bulk resource industries with massive infrastructure and labor implications. Demand for coal was supercharged to fuel steam engines, heat homes, power factories, produce iron and steel, and it became a pillar of industrial society. For the first time, mines used steam pumps, rail tracks, and explosives to reach deeper coal seams. Labor moved from artisanal or seasonal mining to wage-based permanent employment. Coal mines needed more capital than earlier surface or small-scale mines. Investors pooled money through joint stock companies, and this led to some of the first modern mining corporations. This had huge societal impacts. Cities, railroads, navies, and entire economies were run on coal power. And it wasn't just a mining activity, it became a pillar of industrial society. London became a global hub for mining finance due to the British Empire's reach and the financial infrastructure that supported colonial ventures, including mining in Africa, India, and Australia. As mining moved into frontier regions like Canada, Australia, and South Africa, local exchanges developed in the late 19th and early 20th centuries were established to support exploration development. These regions had rich geological endowments, relatively stable political systems, and British legal frameworks which favoured investor protections. Mining booms such as the Klondike Gold Rush, the Poseidon Nickel boom, the Broken Hill Silver Lead Mine Rush drove investor interest and the need for speculation-friendly markets. I wanted to dive into one example of Poseidon Nickel, a junior exploration company based in Western Australia in the late 1960s. In September 1969, Poseidon announced a significant nickel discovery at Mount Windara near Laverton in WA. At the time, nickel prices were surging largely due to a global shortage of nickel and increased demand from the US military for the Vietnam War. Poseidon's shares went from 80 cents to over $280 a share in less than a year, nearly a 35,000% increase. This market frenzy spilled over to dozens of other mining and exploration stocks, which created a full-blown mining stock bubble. Investors believed there could be another Poseidon-like discovery around every corner. Poseidon was one of the largest speculative booms in Australian financial history. This bubble burst by the early 1970s as Poseidon's actual nickel deposits were actually less than expected. Nickel prices fell and there was overhyped companies collapsed. Many investors were wiped out, which led to a government inquiry into the regulation of the Australian securities industry. And this Poseidon episode cemented Australia's reputation as a place where junior mining companies could raise speculative capital quickly. It also highlighted the volatility of resource-driven markets and the need for better disclosure and regulation. This shaped the development of the ASX and other junior markets and influenced how speculative mining capital would be handled for decades to come. During the post-World War II present era, mining remained high risk and speculative, especially in early exploration. Junior miners became a common model whereby early explorers raised high-risk capital to discover resources and then sell or partner with majors. The capital markets, especially those willing to support high-risk and high-reward plays, became essential in these regions. The culture of speculation and risk capital, combined with the vast geological endowment of its countries, makes Australia, Canada, the main hubs of mining finance today, followed by London. Australia, Canada, and London all have a deep pool of retail and institutional investors who are comfortable with mining and resource risk. The TSX tends to have a geographical focus on financing projects located in the Americas. Canada also has government incentives like flow-through shares to help investors offset risk and cost. The ASX typically finance projects located in Australia, and its proximity to Asia gives it an edge in financing projects in Southeast Asia and the Pacific, and also in Africa. London's legacy as a financial hub and its imperial past give a global reach, but a strong focus on European and African projects. These markets are all relatively transparent, well-regulated, and investor-friendly for speculative assets. Exchanges like the TSX and ASX have clear technical reporting standards and guidelines that build investor trust. These are called NI 43-101 in Canada and JORC in Australia. These markets have a high concentration of experienced mining analysts, geologists, engineers, mining-focused lawyers, specialized mining investment banks and brokers. And these exchanges allow early-stage companies to list, raise money, and use that capital to fund exploration. These companies are financed by discounted equity capital raises, sometimes with a free attaching optional warrant. For early-stage juniors, the effective cost of capital can be up to 15 to 30% per transaction, which is pretty wild. And for later-stage developers with defined resources and good market timing, the cost of equity capital can drop to 7 to 12%. China figured out quite some time ago how the mining sector was financed in the West. In these smaller tonnage commodity markets such as lithium, China has managed to depress the price for that specific commodity, ensuring that Western developers' NPVs and/or share price charts are weak. The Chinese government also bolsters its equity market through coordinated efforts by state-backed entities, increasing purchases of index ETFs, and large-scale share buybacks by major state-owned firms. You certainly don't see this in the West, and over the next few slides, I'll show you some case studies. So Gallon Lithium is an Australian lithium company with a project in Argentina. Over an 18-month period, the company completed 4 equity placements plus an equity line, which is extremely dilutive. Then, who would have thought, in April 2025, China lobbed in a global takeover offer at an all-time low, which valued Gallon at 2.6 times its market cap. BlackRock Mining, an ASX company with a graphite project in Tanzania, And despite securing the backing of POSCO, the South Korean multinational steelmaking company, BlackRock still had to complete 5 capital raisings since May 2022. Sovereign Metals, a dual Australian and London-listed company with product in Malawi, and despite securing the backing of Rio Tinto, one of the world's largest mining companies, who invested in 2 of these 4 transactions, Sovereign Metals still had to complete 2 equity raisings from the market. Critical Metals Corp was recently raised $22.5 million with 100% warrant coverage. And from further looking into the transaction, you can see that the strike price can be reset. This company got fueled by the SPAC boom in the US. And so as you'll see in the last 6 weeks, this stock has gone from $9 a share to $1.50 in a matter of weeks. Now let's switch to China. Let's look at BYD company. As mentioned, the Chinese government props up the equity market, in our opinion. BYD raised the equivalent of $5.6 billion in March 2025. Since the cap raising, BYD has traded up 25% in the following 2 weeks, which is about 1,000% annualized. So given all of this, we wonder when the US government is going to wake up to how this critical sector is financed and how we can stop being reliant on China.
Thanks, Stu. Thanks, Thomas. That was incredibly interesting and incredibly important. We have some questions from the audience. If you guys continue to submit those there using the questions tab, we will try to ask them. One question that we may be able to answer relatively quickly that came in earlier is, how are critical metals different from strategic metals?
There is no real boundary between the two. The definition relies basically on 3 things. So how tight the growth of demand is for new technologies, especially strategic technologies. That usually means dual use, so civilian and military, or military and civilian increasingly. The secondly, supply risk, and the third, substitution potential. So can that material be substituted? And once you put those 3, you'll find out what's more highly priced than others. And especially supply risk, it's easy to define. So from the United States perspective, it's either domestic, allied, global south, or China and its allies, right? So 4 different types. And then you just have to figure out like how risky it is for that supply. However, each country will have a different list. We've seen lists, I think, from 5, 6, 7 countries that have a grand strategy, because it has to be a sizable economy with a grand strategy. And so they do not necessarily overlap. I mentioned earlier that for China, iron ore is a critical mineral, and so is gold, by the way, because it's a form of diversification away from the dollar as a source of reserve. And interestingly enough, in the announcement, the Liberation Day, several metals were mentioned, critical minerals were mentioned as exempted from the reciprocal tariffs, as well as several other metals, and that included gold. So the question is whether the US is also changing view of gold as being critical. So it's really in the eye of the beholder, what's strategic, what's critical. But between the 2 fuzzy definitions, I think we would mostly use critical minerals, but it's not very different from strategic. You have to simply find out what it is, what is the list, and how different it is between, say, India, South Korea, Japan, Europe, US, and so on.
I think that leads into a question I have. What are the minerals that are the most exposed to political decisions regarding international trade?
So we know that already because these restrictions have already taken place. So clearly among rare earths, dysprosium is high on the list. It's one of the heavies, and is the one which, in addition to its traditional historical uses, together with terbium to increase the performance of magnets, especially in high temperatures. Dysprosium is also increasingly entering new solutions for semiconductor business. So very critical and very constrained, because you need mostly ionic clays historically. Not so many yet functioning deposits of that style in the West. It will change, but for now, dysprosium is very tight. Another one outside of the rare earth space would be gallium, again, of critical importance for semiconductors, mostly as gallium arsenide or gallium nitride. And I would throw in antimony, which is slightly larger market, but that's because the West just doesn't have any capacity to process it. I mean, there's one small company in the US, but the only smelter that exists in Oman is currently offline. I don't know how much they actually process. It's in the interest of 3 or 4 new development companies that are basically digging into mostly gold shear zones with what used to be an antimony byproduct, have now basically rebranded themselves as antimony miners. It's in their interest to go to Oman with some support of Western governments and do something about it, because otherwise it's going to take a long time to rebuild that value chain. And that's also under sanctions, under Chinese sanctions. As I mentioned before, China is very richly endowed with antimony, and they have also the processing capacity, which we don't. So I'd say these are the 3.
Stu, anything to add?
I think Tomasz covered that one.
How do regulatory delays and never-ending legal challenges in the U.S. compare to those factors in China?
I'll let you talk about China, Tomasz, and I can talk about Canada and the US.
Okay, go ahead.
Yeah, well, in Canada and the US, Canada and Australia, massive countries with like 7 main provinces on average, and the population is just dispersed. So I think 90% of Australians live within 100 kilometers of the coast. 80% of Canadians live within 100 miles of the US border. So going to permit mines for new discoveries is a lot easier. There's typically, the states are humongous, and there's limited population compared to, say, the US, which has 50 states, 50 capital cities, very litigious system. The geology doesn't really care about state lines. However, sometimes there's mines that cross multiple states, so it can become quite complicated. And I think the US is the second worst country in terms of timelines, averaging 20 years from discovery of a mine to permitting. But Tomasz, in China, if you could add some more on that.
Yeah, so first, you don't have private property in China, so you don't have the issue that we have here between private, state, federal, and so on, right? Everything belongs to the state. And so you have 3 types of land attribution: rural, industrial, and residential. Rural can only be leased for 30 years, so its accrual value is much lower than residential or industrial. Residential and industrial are 70 years. And it's at the discretion of the local authorities how you allocate that. So if you just switch it from rural to residential because a realtor comes to you and says he's going to build a new city there, you'll just do it at a price, but you just do it. What's important is economic activity. And so if economic activity is guaranteed by mining activity or processing and so on, you will do the right thing and reassign land to a different use. That's what you're going to do.
Great. It's certainly hard to keep up with the news and what changes hour to hour, but how does the current trade war affect the relative balances in critical minerals?
So you're right, it's difficult to keep up. We just had an event 30 minutes before we clicked on here. I think if you followed since the very beginning, a lot depends on a geological endowment. And no matter how hard the United States is trying, it's going to be very difficult to redevelop this particular value chain, that is metal and critical mineral production, without some support from the US allies, especially in the UK. And what Stuart alluded to is what we're banging on table about for months and years. If companies in Australia and Canada that have access to critical minerals and that have probably more advanced projects mostly are considered Title III Defense Procurement Act companies in the United States, there's no reason for them not to benefit from capital, US capital. And right now, this is not the case. They're kind of isolated in those relatively illiquid equity markets out there and trying to vie for survival against the Chinese state behemoth. So the solution is there on the capital side. In terms of the actual flows, I mean, we saw the fireworks last week. So what I mentioned is that critical minerals were exempted from reciprocal tariffs, and subsequently the Chinese restriction affected it. Importantly, it didn't affect just it didn't impose restrictions on exports to the United States. It imposed restrictions on exports, period. And so the countries that are most affected, actually not the United States, but Japan, South Korea, Taiwan, and others. So, always be nice to your neighbors first, right? In a way, that shows that there is sort of a deeper reason there. I mean, China is using a fig leaf of a non-proliferation treaty, so suddenly, supposedly, exporting lutetium would have nuclear proliferation consequences. It does in a way because lutetium is important for sonar transducers, which are in submarines or anti-submarine warfare. You can basically translate every single critical mineral this way by association. But we will see definitely more division, and we will see more stockpiling. More stockpiling means also they want more demand for most of these things. So I think investors should brace for themselves for it. And by the way, in the last couple of days of terrible, $15 trillion, whatever the number was at the bottom, lost in the equity market and then in the bond market, the one company that really stuck out was Lynas, a rare earth producer from Australia. That was a company which I think gained 9% over those first 3 days. So it shows you that it's really time for investors to start paying attention to what is one of the core elements of the trade war and will remain so.
Great. Are there new market opportunities emerging in light of the current volatility in the critical mineral markets?
Stuart?
Yeah, I mean, all the companies have to continue operations, and the world does go on. We're seeing plenty of opportunities out there in the antimony space. The antimony price has not moved, and a lot of the antimony projects are correlated with gold. Gold price has gone up, and it's enabled some great bargain hunting out there for some of the antimony names who have dropped just for no reason in our view. And then, in terms of new markets, I mean, more and more companies are trying to list in the United States. It's such a big capital market base here. And, I think as for US investors, they need to realize that most of these companies, they want to buy an antimony company or, a nickel company. There aren't many opportunities in the US on the US stock exchanges. You have to look globally. And, geology is a global reality. So, and the reason I outlined earlier, the history of it and the mining sector is where these hubs in London, Australia, and Canada have been created.
Great. As we start to wrap up, I'm curious, what do you think is the single most important reform that could unlock long-term investment in critical materials and sort of change this trajectory? Wrapping it with closing remarks.
Yeah, well, definitely permitting reform. I mean, this was in the offing last year over several months, and then didn't get into the omnibus towards the end of the year as the election had, more emphatic result than we thought here in the US. But it has to go through some kind of permitting reform. Whether it's going to solve all the issues now, because the courts are what they are, and of course we're going to have a battle with courts over many issues here. And depending who's sitting on a court, if it's a conservative judge or a liberal judge, there are different chances of this going through or going to a higher level. So I think it's we have a lot of battles to win still. But I think the fluidity of capital markets, this is kind of up in the air, depending how the current remodeling of the U.S. relations in general proceeds. So it's very difficult to predict what that would mean for the role of U.S. capital generally in the world, as opposed to the role of foreign capital in the United States.
Yeah, I think I'll add to that. Seeing a lot more discussions of this sector. Any discussion in the news on the mining sector is good for our business, and seeing from CNBC to Bloomberg to NPR, Wall Street Journal talking about Australian, Canadian mining companies, that never used to happen about 10 years ago. So more press is good, and will make the US society, aware of where these minerals come from, and that should in turn change things in DC and, improve capital flows, in our opinion.
We did have a question that came in on if the mineral prospects in Greenland are real, and I would encourage you. We spent some time on that at the previous webinar, and the replay is available. Stu did an excellent job delving into that, and so we'll make sure to share that with you, James, afterwards. And so with that, we'll wrap up today. We want to thank Stuart and Tomasz for their insights. We want to thank our friends at Coherra for helping us present today's program. And of course, we want to thank all of you for tuning in and being with us today. A replay will be available following the webinar, and up on your screen now, you'll see the contact information for AMVEST TERRADEN. We also invite you to visit our website, amvestterraden.com, to learn more about our ongoing work. And please reach out if you'd like to learn more and chat with us further. Again, thanks, folks, and we hope to see you again at the next one.
Thank you.
Thanks for that.